Welcome back. We're back with Dan Rohinton. Dan is portfolio manager at IA Global Asset Management. In this conversation, we're going to talk about some stocks that he likes and has been buying on behalf of his clients, and they are all well-known technology stocks. Let's start with Microsoft. That's the first on the list.
Yeah, and once again, it's important to understand that just because it's large and well-known by many people around the millions and billions around the world, does not make it an unattractive opportunity. So hiding in plain sight, and what we see in Microsoft is we see capital intensity that has reached significant levels starting to normalize back down. And that tends to mean for Microsoft during these cycles, you see revenue hold in and you see capital expenditures come down. So free cash flow tends to expand during these environments. So when you think about the best, most diversified distributor of technology in the world, trading at its relative lows on valuation, that is an attractive entry point for this company, and we have been buying.
When I spoke to another guest earlier this morning on things like this, these are elite, highly regarded stocks where often the only criticism you hear is that they're overvalued or fully valued. His comment was, yes, but is the earnings outlook the same as it was before all this global uncertainty happened? What would your view here be? That the tariffs unlikely to affect the earnings profile at Microsoft? Would that be your view?
It's largely going to be immune to it, with one caveat, which is a risk that's worth talking about, which is the anti-coercion rules by the European Union are one of the most direct ways that they could harm the United States if the trade dispute were to get toxic and poisonous. That anti-coercion rule effectively allows them to, curtail the activity of companies like Microsoft, Meta, Google in the European continent. So that is one of those elements which is a left tail risk, which is why it's important to bring it up. But I think it is unlikely it goes down that road, because besides that, you have a pretty recession resilient business that's seeing a cash flow inflection to the upside, trading at a relative low on valuation.
Okay, another very well-known stock, Amazon.com.
Yep. Tariffs are going to have an impact. Fulfilled by Amazon is going to have some impact because a lot of the merchants were coming from were Chinese merchants that were selling through Amazon through FBA. But this is the best retailer with the most diversified footprint, with the ability to trade down from the more premium products all the way to Amazon Basics. So they are the best position of any retailer in the world to manage through this type of tariff environment. So, and that forgets the fact that Amazon Web Services is the other half of the business,
right,
where that same dynamic about capital intensity being record highs, coming down, and cloud growth being resilient, albeit still very strong, is a great news story. And now it's at the cheapest that we've seen in a very, very long time.
Is Amazon Web Services, the cloud computing business, does it factor into the multiple here? Is it something that the market pays attention to in terms of results and performance?
It does, and it's the same dynamic as Microsoft as well, where the capital intensity of Amazon Web Services has been going up because they've been investing in AI infrastructure. So that is one dynamic where as that normalizes back to a reasonable level, the top line tends to hold in, the margins tend to expand, and then the free cash flow conversion improves. And the retail business is a bit more on the spotlight today because they were finally realizing profits in it after basically 25 years of pretending like it's not profitable.
Right.
We know now it's wildly profitable.
Okay, let's go to the final pick, Alphabet, the parent of Google.
This is a pure value call. This is some of the most distressed prices that we've seen in Google ever, and there's good reason for it. Is OpenAI a direct threat to Google search queries? Yes, it is. Are they holding and growing on the cloud business as much as the other two companies we just talked about? No, but it's still a viable third player in the market. And we're talking about one of the most easy to optimize companies when it comes from a margin standpoint. So if you think about levers to pull, Google has it all, and it has distribution scale to make large language models work, albeit I don't think they're going to be that disappointed if it becomes a commodity over time.
Currently trading at 17 times expected earnings. That is historically low for Alphabet, correct?
Yes, and it's on its way to 14 times on a forward basis.
Dan Rohinton, thank you very much for joining us.
Thank you.
Dan Rohinton is with IA Asset Management. Coming up, investors are seeing a reprieve in the market rally today.